Okay, so chapter 10 is on budgetary control and something called responsibility accounting, which we're going to look at Wednesday afternoon. Today, our goal is to get through the first two learning objectives. And so we're going to start with objective one. So, what is budgetary control? And then we're going to look at what's a static budget report. And so, first of all, understand that budgets are meant to help plan what's going to happen for the year in terms of sales and costs. And so, in and of themselves, they're sort of a perfect device to use as a control device because you simply already planned it out. So when the actual numbers come in, it's easy to see how, if you were as expected, if you missed the mark, and if so, by how much, and was it more than you expected or less than you expected. So when we look at budgetary control in this section, we're going to be looking at the difference between actual results, what actually happened, with your planned results. Remember, budgets are forward looking. You're planning for the next year, right? So it hasn't happened yet. That's the expectation. So once it actually happens, woo, you have actual numbers, and then you can start comparing. Okay. It does help management understand how operations are going. It allows managers to analyze the differences and find out what's causing either the good news or the bad news from happening, or in that sense. Right. So your book has an illustration on page 412 that indicates, you're developed a budget. You're actually looking at the plan versus what actually happened. You're analyzing the differences in those types of numbers. Then you go ahead and talk about how you can correct things that might be going awry in your plans. And thus you can modify your future plans and redevelop some more budget expectations based on that. So it's a whole process, and this happens in companies all the time. Okay. All right. So budgetary controls, actually, because there's so many different budgets, it's important to sort of understand that all of these budgets are going to be used to provide that type of information. So remember, we started with the sales budget, we moved all the way through the production budget and all the different costs, et cetera. So basically, what happens is the name of the budget report is going to be identified. It's important to know how frequently they need the numbers. So is it a weekly report? Is it a monthly report? Is it a quarterly report? How frequently do they need to check on these types of things? What's the purpose of the report? And who's going to be the primary recipient or recipients of those reports, usually in the management category. And so here's some some examples of budgetary control. So the sales budget, often it's a weekly budget to see whether sales goals are met. Who's going to get that? Well, of course, top management wants to know because that's their main revenue projections. And of course, sales managers are going to need to know that to see whether they're on target, above target, below target, et cetera, and take corrective actions to it. There's costs report for labor. Again, that's usually a weekly cost report. And the idea is to make sure that you've identified and can control all your labor costs. Often this goes to production or to production department managers for this. So again, they have all the different types of reports here. They're based on the budgets, and they have a purpose. They have a frequency. They have a purpose, and of course they have the recipients in terms of the management that is you using that report to help them manage, whether it's a department or whether it's a division or whether it's the whole organization. Okay. So we could modify future plans, analyze differences, and determine the differences between what actually occurred to what we had planned. So we're going to introduce yourself to a new budget today, a static budget. You've sort of already seen one, but a static budget is a projection, assuming there's only one level of activity, meaning 10,000 units are sold for the year, or assuming, some other factor, but often we'll start with the sales budget. So a static budget is a projection at just that one level of activity. The problem with the static budget is it ignores different levels of activity. And as we looked at way back in the early part of this book, there are different levels of activity in terms of the capacity that the plant is going. Sometimes it's only running at 40% capacity. Sometimes it's running at 80% capacity, and anywhere in between. And we call that the relevant range. Well, the static budget doesn't take into consideration the relevant range. It only takes into consideration one range. And so we have to understand that and know that we need to correct it by looking at multiple levels of activity, not just one. So here is an illustration of, this is in your book, on page 413. Okay. So here's the static budget that shows the actual amount, the budgeted amount of sales in the first quarter with the actual amount of sales in the first quarter. Okay. Knowing that they were budgeting $180,000 of sales for that quarter. What actually came in was $179,000 in sales. That's $1,000 difference. That's not in their favor, right? They budgeted for more sales than they actually got, right? They were $1,000 short in the sales department, in the sales area. Okay. So that difference means they didn't meet their expectation. They were actually under their expectation. In the second quarter, it's much worse. Right? They had budgeted $210,000 in sales. That's how much sales they had expected to do in the second quarter. When the actual numbers came in, it was only $199,500. That's a much bigger difference, $10,500 under what they wanted to do, right? They had budgeted this amount. They only got to that amount. They were short. They basically were short. A much bigger problem from the first quarter. I mean, it's one thing being off $1,000 in sales. That's not a huge deal. 10,000, that's a huge deal. Okay, particularly because the numbers here are relatively small, 180,000, 200,000. So a $10,000 difference is big comparatively. When you look at it in total, they wanted to bring in $390,000 in the first half of the year. That was the budget. That's what they've expected. They actually only brought in $378,500. So they were short 11,000, which are these two numbers, right? So this total is the first and second quarter together. And that's in your book here, illustration 10.3. So we have to understand that when it comes to a sales budget, illustration 10.4, this is page 413. Okay, page 413. When it comes to a sales budget, when you actually don't meet the budgeted amount, it's considered unfavorable. unfavorable. For sales, because you're short. So in this case, you were projecting sales of $180,000. You only got $179,000. So it says here it's $1,000 unfavorable difference because it wasn't as high as you were expecting. This sales budget is money coming in. Anything short of that is unfavorable, right? It's kind of like expecting to receive $200 from your check, and you look at it's only 150. It's unfavorable to you. You were expecting more money coming in than you got. And so that's how we look at a sales budget report when we're looking at the differences, favorable or unfavorable. Favorable would have been money, it would have been higher, right? We wanted to sell 180,000, we sold 190,000. Oh, we sold more than what we thought we were going to sell. Favorable. In this case, we sold less than we thought we were going to sell. Unfavorable. Unfavorable. That makes sense? Of course, in the second quarter, it just was extremely unfavorable, right? Because in the second quarter, we had expected to sell 210,000 worth of this product, right? It's a right ride. We only sold 199,500. That was well below what we wanted to. So it was unfavorable by 10,500, much below what we wanted to. And yet, even for the year to date, so this is only the first two quarters, first quarter, second quarter, we had budgeted 390,000 in revenue for the sales of this product. We only sold 378,500. So we had an unfavorable difference here. We did not meet our sales target by $11,500. So this is what they mean by a difference being favorable and unfavorable. But again, this represents strictly the sales report. It's going to work different. It's going to work differently when we look at our costs. But for sales, it's below what we were expecting. So it's unfavorable. So static budgets, again, they only look at things from one activity level. And that's a problem. That's a problem because the actual activity level is going to be different oftentimes than the planned activity level. But a static budget doesn't really reflect all of that. Of course, fixed costs are not going to change. Right? Fixed costs are going to be, you're paying rent of $10,000 this month, whether you make or sell 10,000 or 12,000 units. It doesn't matter. The rent is the same. However, variable costs are going to change dramatically if you make more product or if you make less product. These costs are going to change dramatically. So one static budget is not really relevant. We need actually to look at multiple levels of activity and what our profit and loss would be from each level activity. Okay. So static budgets are great for fixed costs. They basically suck for everything else. Okay, because the actual amount is different. Static budgets only look at one activity level, only one. So we're already at our do it exercise for objective 1, which talks about static budget report. So here, this is on 414 if you have your book. So this is page 414. Lawler Company expects to produce 5,000 units of their product CV93 during the month. Budgeted variable manufacturing costs per unit are $6 in direct materials, $15 in direct labor, $24 in overhead. Monthly budgeted fixed costs are $10,000 for depreciation, $5,000 for supervision. So here's our base. in the current month, Lawler actually produced more, 5,500 units, right? They were budgeted for 5,000. They actually produced 5,500 units, 500 units more, and incurred the following costs. Direct material costs, 33.9, direct labor costs, 74.2, variable overhead, 120,005, and of course, depreciation division are fixed, they stay the same. Prepare the static budget report. Okay. And so as you see here, the first thing we're going to do is do two columns. The budgeted column, which is what we expected at 5,000. And the next column here is what we actually did. We already know that the variable costs for this is $6 for direct labor per unit, for direct materials per unit, $15 direct labor per unit, overhead $24 per unit. So the variable costs are going to be different for 5,000 than they are 5,500. Fixed costs, as you'll see, don't change at all. Oh, let me go back a second here. So 5,000 units at $6 for direct materials is 30,000, but 5,500 units at $6 is 33,900. So this is unfavorable because this is a cost. Your costs are higher, that's unfavorable. But of course, here you're budgeted 5,000, you actually did 5,500. Your direct labor is $15 times 5,000 here, times 5,500 here. That was favorable, actually, you had lower costs. So the fact that the cost was lower is a favorable thing because lower costs favor the
What'd you call me for?
I think we got some, I have to put Peter on mute here. So we have direct labor with a favorable difference here. Overhead at $24 times 5,000 here, times 5,500 here, that's unfavorable. So as you see, your variable costs are going to be different at different activity levels, right? For 5,000, it's lower, right? For 5,500, it's a little bit higher. And so it's unfavorable because it's a cost. It's costing the company money. That's unfavorable because it takes away from profit. Right? So that's the total here. And this is what a static budget looks like. Static budget report looks like when you have the budgeted amount with the actual amount. Okay, so I'm going to stop there, bring us back to our main Zoom meeting for questions.